Okay, have you ever noticed how certain price action patterns sometimes just quickly get stopped out? Like, you see a big bullish and pin bar on a daily chart, you do all your technical considerations, it looks solid, you position, and then it quickly gets engulfed the other way. Now that's where you say, no more technicals, focus on fundamentals. So you focus on fundamentals, and those are important to consider decisions. You completely ignore the technical side, you do your considerations, power is hawkish, and the market just goes the other way. Now, you kind of know where I'm going with this already. The point is that you shouldn't isolate just one aspect from the other, because it's not just technicals or fundamentals, but it's technicals and fundamentals. Now, you know that, I know that, we all know that, so let's actually put the theory into practice, because it's easy to just theorize things while instead the practice is a lot more complex. So let me ask you, have you ever thought really about what creates the price action? It's market participants, of course, yes. But exactly which market participants? Because that makes a difference. Let's say a big bullish pin bar is created during an FOMC meeting. What does that make you think? Now, mistakenly, a lot of traders think that the price action created during a fundamental event is just noise. Well, that's completely the opposite. Because think about this. What happens during an important fundamental event? Large macro traders, and with large macro traders we intend well-informed traders, they just loaded up on some positions for the market to move in a specific direction. Now, what if instead a large bullish pin bar happens during the HS session, like randomly? No headlines, no data, nothing. Would it be as meaningful as the other example? I will tell you no. But why exactly? Well, because the participants behind the price action are completely different. In other words, with technical analysis, there is one side of technical analysis, and there is this side of technical analysis that is backed by fundamentals. Now, that's an important distinction because there are many different types of participants in the market. Some are there to speculate on price fluctuations, and some are not. So by intuition, you can already start to think and understand that the price action formed by one type of market participants is different, is more meaningful than others. Now, with that distinction already in mind, you can begin to filter out a lot of false signals created by random market flows. So what I'm trying to say here is that if you want to level up or sharpen your technical analysis, then you should start to make sense of the technicals with fundamentals. So put into context the price action with fundamental events. So how can you do that exactly? Well, you see a pin bar on a daily chart, you see an engulfing candle, anything else. The question to ask yourself is, what actually formed that price action? Was it just random commercial flows, rebalancings, another kind of activity that is not really relevant for the market sentiment and direction? Or instead, there was actually a fundamental catalyst, a real event that shaped the flows and sentiments in that specific moment, resulting in the creation of that specific price action. Then you know that you're looking at a specific pattern that is representative of a real sentiment coming from a real fundamental event. Now that's a very powerful way to put it. So technicals alone are okay, but technicals backed by fundamentals are better. Now let's see an example. This is a trade on EuroGBP that we shared on our public Telegram channel, and you can find the link about that in the description below. Now you can see precisely how in this particular trade we backed the technical aspect with the fundamental context too. So there was that bullish engulfing on a daily chart that was suggesting in and of itself that the pair wanted to expand higher. Now that's great. That's a great indication already. But now the key question to ask is there anything that actually created that bullish engulfing? Now, the answer to that question gives you the context to understand whether the price signal that you're seeing on the chart is actually an important indication or it's just technical noise. So yes, it's price action, but it's price action with more context around it. So why did that pattern form? That makes a difference. Now, what about fundamentals instead? So let me show you another example. As you can see, the trade idea starts from one core element, the FOMC rate decision. In particular, this trade was a result of a meeting where Powell went in a bit more hawkish than expected with his comments during the press conference, and that hawkish tone triggered a wave of dollar buying. So the event put the fundamental context in favor of dollar strength, and as a result, also shaping some price action that was indicative of dollar strength across most currencies. Now, AUD USD set up that short opportunity, and basically in simple, the fundamental sentiment suggested dollar strength, price action across the board point to dollar strength, and there were also on top of that some seasonals aligned in the same direction. Now that makes a trade. That makes actually a solid trade. So what's the story here? Why is this important? Because yes, it's fundamentals, but it's not just fundamentals. Yes, it's technicals, but it's not just technicals. That's how we operate. When we look at technicals, we make sense of it with fundamentals. And when we look at fundamentals, we confirm it with technicals. Now, this is a bit easier said than done, of course, but we do this, and we do it consistently. And I can tell you, it's the right way to make and keep your trade ideas consistent and effective.